Very good evening, all of you. On behalf of NISM, I am delighted to welcome you all for today's webinar on financial mathematics. I am Neha Deshmukh, working with NISM. Joining us today are esteemed industry expert who will be leading the session. It's my honor to introduce today's speaker, Mr. Rohit Verman, lead trainer at Quantify. Before we begin, let me take a moment to introduce our esteemed speaker. Mr. Rohit Verman, having 19 years of financial service experience in equity advisory and financial modeling, worked with Serum Institute of India Limited, Motilal Oswal Security Limited, and ICICI Security Center of Financial Learning. Currently directly involved in real-world finance and automation, fundraising, and academia. On corporate financial automation side, working as subject matter expert for fintech projects for asset management companies and financial modeler for private equity. He is associated with SEBI as security market trainer for financial education programs. He has done graduation in computer science and post-graduation in management and professional qualification in financial analysis, financial planning, and wealth management from US-based professional boards. Once again, a warm welcome to Mr. Burman. Before start the webinar, let me briefly introduce today's topic, financial mathematics. It is the application of mathematical methods to financial problems. Equivalent names sometimes used are quantitative finance, financial engineering, mathematical finance, and computational finance. It draws on tools from mathematics, probability, statistics, and economic theory. Traditionally, investment banks, commercial banks, hedge funds, insurance company, corporate treasuries, and regulatory agency apply the method of financial mathematics to such problems as derivative security valuation, portfolio structuring, fixed income security, risk management, and other portfolio management. So, I warm welcome to our today's guest, Mr. Varman, for the today's session. Some important announcement for the participant. We will take all the questions at the end of the webinar. Please submit your queries in Q&A board. All the participants will receive participation certificate within 3 to 4 days. The recording of the session will be available on NISM YouTube channel. Now, without any further delay, I would like to hand over this session to our speaker. Over to you, sir.
Yeah, all right. So good evening, everyone. And thanks a lot, Neha, for introducing and NISM for giving this opportunity. Okay, so first thing is, it's, when we say financial mathematics, so, generally people always have some kind of phobia with mathematics, but I always say that, I am for mathematics and I am for money, and all this financial market, is made up of money only. It's a wide topic, like as Neha introduced. It's very wide topic, and we cannot cover all the things, even in let's say 1 month time period. But what I think, as the current global environment, that everyone talks about the rate of interest rate, and the central banks around the world is playing with the interest rate. So I thought, like, let's take the subtopic as the interest rate only, and let's see how it works. So in the next 1 hour, we are going to cover, first we'll go with the concept of interest rate, and then what are the different types of rates, how to convert one rate into another rate, and why it is needed, and all this through the applications. Now I can see there are good number of participation. Okay, I only request that to make it more fruitful, and to be an objective, to fulfill the objective, you sit with the spreadsheet, because these are the calculations. So most of the time I will be using the spreadsheet only. It can be any, like Google Sheet or MS Excel can do wonders, right? Otherwise it will be just you are listening, and that will be just the one thing, right? So to have a hands-on experience, what I want is you sit with the spreadsheet. It make it more impactful. right, so I can see a lot of okay, so a lot of chat, fine. So the last thing what I'm seeing is say in Hindi. All right. Okay, so I'll keep a mix, right? So mix of the Hindi and English. So the thing is, now you please focus on the, the learning part. As of now, please stop putting in the chat unless and until you have really a very strong point, then you can raise, right? Don't put in the chat. It becomes difficult to manage all the things. All right. So fine, fine. All right. So the first is I'll go with my first slide, which I think Neha already introduced. Only thing I'll go with the color font, the blue color font, where I am focusing more on the fixed income securities, uh, where the rate plays very important role, because all the fixed income products, whether it is a bond or any debt instruments, or even the insurance, right, the corporate treasury, they all work around the rate of interest only. Okay, so as I already said, the focus will be on the rate of interest, right? Okay, of course, with the data, I will be using some real data that I will share once I start with my numericals. All right, so let me go with the first thing is, I think I should put off my video. All right, so the first is, let me go with first the concept, okay? Okay, so the first thing what I'm showing here is certain advertisement. Intentionally, I crop the issuer, right? So who is issuing these bonds? I intentionally crop those names, okay, so that we can focus on the main thing. Okay, now if you see here, on this, all these are the NCDs, that is non-convertible debenture paper advertisements. And the thing is, we have to focus on, it says 11.02% per annum and 60 months, right? And again, it says effective yield. So again, this is something technical, right? So we will understand what is this effective yield, why it is quoted in terms of effective yield, okay? Another thing, when it comes to the finance, we have a lot of synonyms, right? When we say yield, returns, they connote the same thing. They have the same meaning, right? Those things we will understand later on. But as of now, when you see the word yield, it means return only. Okay, same with the other advertisement, it says up to 10.75, right? So so this is again the rate of interest quoted. Okay, few more, couple of more you can see here. Okay, again, if you see, observe here that the rate of interest is going up, right? So if you see this red color advertisement, if it is a 13-month time period, then it is 11% per annum, and up to 60 month or 5 year, it goes up to 12.5%. Same way this green color, right? It says 9.15. One more thing you have to observe here, in this green color, below this, the first bullet point, what it says is effective yield. So everywhere what we can see is the effective, right? Okay, one more thing you have to observe. Again, in the third bullet point, it says the monthly, yearly, and cumulative options. So these are the options given. That means if the investor is looking for monthly payouts, then there is an option of monthly. It can be annual also, and it can be cumulative, means when the bond will mature, then towards the end of the tenor, the lump sum amount will be given. So these are the different options. With every option, the rate differs, right? So all those we are going to discuss in next 1 hour. Okay, let me go with the first thing, which I said, the concept of interest rate. Okay, so I'll put some number here. Let me go with, okay, now for example, I'll just put some number. Let's say if I say today 0, and if the person have 9,500, okay, and by the end of a 0th year, we call it 1, and let's say it becomes 10,000, right? So as you requested in Hindi also, let's say अभी 9,500 है और 1 साल बाद वो 10,000 रुपये हो जाते हैं, right? Okay, So first thing what we are going to find is, okay, returns kitna hai, right? So what we will say is what are the returns? Okay, and there are different ways of calculating the returns. Okay, it's all about our intent and what the objective is, how it should be presented. So 9,500 become 10,000. Okay, so yes. So will you try from your side? You can use calculator, you can use spreadsheet. So 9,500 become 10,000. Yes. Okay, so what I'll do is I'll go to my application tool, which is I'm using MS Excel, right? Throughout the workshop, I'm going to use this. So what I said is 0 today, 0 means today 9,500, and next year it becomes 10,000, right? So how we will, going to present in terms of the returns, and it's very simple. What we will do is, 10,000 minus 9,500, which is 500. Okay, and 9,500 become 10,000. So let me go with 9,500 in the in the denominator, and let's see what we are getting. Is it fine? So if we multiply with the 100, or in percentage term, it becomes 5.26 up to 2 decimal. Okay. Now please understand, when I say 9,500 become 10,000 in percentage, what we are seeing 5.26. Or just to cross verify. Okay, so a lot of chat. All, yeah, 5.26. Yes, so I can see a lot of answers. Good. So 5.26. Okay, let's cross verify. Simple. Okay, so 9,500, and when you multiply with 1 plus 5.26, okay, the answer should be 10,000. Correct? So let me enter it, and what we are getting is 10,000. Okay, so what we are, what we can infer from this. Okay, let me go back. What we can infer from this is, okay, we can check this in 3 ways. Okay. Okay, so what we can think about it is that the required rate of return, what the investor expect. The first thing is that 9,500 become 10,000. So what he's expecting, that I should get 5.26%. Very simple, right? So in the absolute terms, 9,500, and 1 year hence it is 10,000. So 5.26 he is thinking, first thing. Okay. Now another thing what you can see here is a discount rate. So interchangeably, when it comes to the fixed income securities or any debt instruments or any structured product, we say what the discount rate is. Okay, so let's understand this concept also, that what the discount rate is. So simple, 1 year hence it is 10,000, और आज की वैल्यू देखनी है, right? We have to find what is the present value. So this is 1 year hence, we call it future value. And let's say if we know 10,000, and if 5.26 is the discount rate, so simple, what we do is we discount it, right? So 10,000 and divide by the discount rate, right? So 10,000 divided by 1 plus. Okay, so I hope you are getting. Okay, please. Okay. Yeah, sorry. So the thing is, see, my voice is full from my side. Okay, my system voice is full. Maybe you please check from your side. Fine. I hope now it is audible, right?
Yes, sir, it is clearly
Okay.
audible.
Okay. All right. So the thing is, I hope I was explaining the discount rate, right? So the thing is, if we know that in future, if it is 10,000, what is the present value? What is the 0th year value? So what we are doing is this 10, we simply discount with our discount rate. So 10,000 and then divide by 1 plus 5.26%, right? And it should be 9,500. So understand, we have done three things as of now. We have taken absolute value 9,500 and 10,000, it goes to 5.26%. Okay, we cross verify that if it is 9,500 and the rate is 5.26, then what the investor is getting is 10,000 in absolute sense. And the last one, what we did is that this is also known as the discount rate. That means if we know the future, right? Like 10,000 is a future value and we want to know what the present value is, we just discounted it. Okay. And the last thing on the slide is I've written is the opportunity cost. Okay, let's understand what this opportunity cost is. So when we say opportunity cost, now understand we have a choice, right? 9,500, either it can be invested at 5.26 or 9,500 can be consumed today. If 9,500 is consumed today, then 5.26% is the opportunity cost. That means it is, this is foregone, right? So the thing is, if 9,500 is consumed today, then 5.26% is lost. Very simple. So these are the three things what we can thought in terms of the rate of interest. Okay, now very interesting thing, how this interest rate is made up of. Okay, so we will see the component, the constituents of the rate of interest. Okay, so let me go with the next slide. Okay, so the interest rate components, the constituents. So the first thing what we say is the real risk-free interest rate. Okay, so the first is real risk-free interest rate. That means again you think about the same example 5.26%, right? So if in a normal circumstances, if we remove all this inflation and the profitability, everything which the interest rate made up of, then 5.26% is simply, we call it real risk-free interest rate. So mostly, when we go practically and when we say risk-free, so what we refer is basically in a money market instrument, we refer the treasury bill, T-bills we refer, right? Or in a longer term, when it comes to the debenture bonds, what we refer is the 10-year Government of India bonds. Fine. So risk-free, basically the reference become more towards the sovereign securities. So the first component of the interest rate is real risk-free interest rate. Now to that, another component is added, okay, that is known as the inflation premium. Okay, now, okay, so one of the question is it repo rate or we call it repurchase? The thing is, those are different, right? Repo rate, again, it is, declared by the central bank only. So we cannot say it is a repo rate, right? Those are between the central banks and the banks. Those are different. Okay, but in a normal circumstances, when we say, let's say the bank rate, or when we say, what the term deposit rate are, so we are talking more in terms of that, and we are talking more in terms of the NCD's advertisement, what I have shown to you. Okay, so I think don't bring the repo as of now. So the thing is, you just think of the NCDs, non-convertible debentures. Okay. So again, just to show you, like if you are not aware of what the NCDs are, okay, so let me go to the, for instance, I already opened the NAC website. Okay, so on the NAC website, just see, I'll go to the market data, and in the debt and fixed income segment, let's see the securities traded on the exchange. Okay, and I'll go with, let's say, the private sector NCDs. Okay, so the first you can see here the symbol, it is 96 IIFL 28, right? That means 9.6% is the coupon rate. Okay, now you think in terms of the coupon rate. I hope it is clear. Okay, so this 9.6% is what, right? So we are talking about this 9.6%. I hope the point is clear now. Okay, so you think of this India Info line, or there are more, you can see this MOFSL, that is Motilal Oswal Financial Services Limited, right? So you think in terms of the coupon. So the first is, real risk-free interest rate. Let's say it is 5.26%, and then what is added to it is inflation premium. So there is always a inflation, right? So those reference point can be whole price index, which is declared by the RBI. So that becomes one of the reference, okay, for the inflation measure. So inflation premium is added to the first point, which is real risk-free interest rate. Okay, next you can see the default. There can be default, right? The issuer can default. So there can be default. So that is also added because there are always some kind of NPAs or default, right? So the default is added. Okay, then you can see the liquidity premium, very, very important. Okay, because some, when we say listed, they are liquid in nature, but not necessarily liquid are also traded frequently. For instance, if you see the, let me again go back to the NSE data. If you see the, this data, the first one only, let's say India Info line, and if you see the volume, right, it says, 4,103, right? So the volumes are quite low. I'm not saying these are illiquid in nature, but the liquidity is less, right? So the liquidity premium is added. And the last one, it says the maturity premium. With more maturity, the rate increase. Okay, this also we have seen in this advertisement. So if you see the 13 months, it is 11%, but when you go to the 60th month, 60-month time period, it goes to 12.5%. So the longer the maturity, the rate goes up. Okay, so this is the basics of the rate. Now the thing is, we have variety of rates. We say nominal rate, then the nominal rate can be like intra-year compounding, then there is effective rate, then holding period, then CAGR, then IRR. Right? There are variety of rates, the issuer present. So let's understand, let's crack those things. So I'll take first example here. Okay, again, I'm going to take the data from the NSE only, and I'll take one NCD, that is non-convertible debenture, and one SGB, that is the sovereign gold bond. Okay, so I'll go with that. Okay, now for the NCD, let me go to the NSE data. Okay, and again, you see here on the NSE data, I'll go with this India Info line bonds only, right? So what it says, the coupon is 9.6, the face value is 1000, and this LTP, that is the last traded price, is 959. And one more thing we need is the maturity, because please understand, when we say interest rate or fixed income securities, they are always time bound. These are the contracts, right? So they have the maturity. So the maturity, you see, it is 28, right? 24 June 28. So one data, we are going to take this. Okay, so let's say I'll start with, and I'm taking the round figures, not exactly months, like, right? Now, suppose, as of now it is February, but the maturity is June 28th. So I'm taking the uniform period to make it, to keep the thing simple. Okay, now what we can see on the exchange, what the price, okay, so the price is 959. Okay, please try to understand. So if we buy the NCD on the exchange, what the price we have to pay is 959. Okay, this is the price. Now since it is cash outflow, so better what I'll do is I'll put minus 959. Okay, so to the application we have to tell what is outflow and inflow. Okay, so I'll put 959, minus means cash outflow, and then there is a coupon, right? And what the coupon the India info line is offering is 9.6%. So I'll do quickly 9.6 on the face value of 1000. So always remember, I hope you know the basics, right? Okay, so like dividends, the rate is always like dividend is calculated on the face value. Same way the coupons or the rate of interest is calculated on the face value. Okay, so I'll do quickly here. So 1000 into 9.6, we get 96. So 96, fine, and then 96. Okay, now the thing is in 2028 it will be matured. So what the investor will get is the principal back. Okay, so 1000 rupees the face value, 1000 rupees back, because it is a debt instrument, right? So these are the cash flow you can see. So we have the cash flow, and let me put these are the years. I hope it is clear till now. Okay. Now the thing is, if the cash flow is represented and we have to convert into the percentage, right? These are the absolute figures, and we have to see the returns. Okay, how we can go about it? And simple, the one kind of return, we call it internal rate of return. So let me go with the explanation of internal rate of return. Okay, so first is, let's see what the IRR is. So we'll go with IRR. Okay, again, it is an inbuilt function IRR, and refer all the cash flows. Okay, and see what we are getting is 11.29. Okay, now thing is, what is this IRR, right? So as of now, I will explain one part, and later on, after some more kind of returns, types of returns, we will again come back to the IRR part. So the first thing is what this IRR is. Okay, now if you have studied finance, then you know that how we define the IRR. So how we define that, we say that it is a rate, again interest rate. Okay, so it is a rate at which the NPV becomes 0. Okay, so it is a rate at which NPV becomes 0. Okay, now what we mean by that? Now we know when we say NPV, net present value, that means present value of the future cash flows. Now you please try to understand, as of now, today, 2025, what an investor is paying is 959, and these are the future cash flows. All these future cash flows, if you discount and bring to 2025, then it will become 0. Okay, so please understand how. So again, a ready-made function, the inbuilt function we use. So NPV, what the IRR we are getting is 11.29, and the cash flows, what the answer we will get here is 959. Okay, so let me enter, and what we are getting is 959. So the thing is, this is plus and this is minus, and it becomes 0. Is it fine? So maybe if you are from the finance, you studied finance, you have done this in your copy, but how we can do on the spreadsheet, I'm explaining you in a Excel way. So again, I'll repeat, the outflow is 959. Okay, the inflows are 96, and then 96 plus 1000, since it is a debt instrument. Okay, so 959. Okay, what is this 959? So 959 is the price of the bond, right? So you see this, I've taken the data from the NSE. I hope you can see, everyone, LTP is 959. I hope you're getting right. So LTP is 959. The coupons are 9.6. The face value is 1000 and the maturity is 28. And again, I'll repeat, I'm not taking exactly 24 June 28, but a uniform period. So now the thing is, if you are thinking why we are putting minus sign, right? So minus because it is outflow. To buy the bond, the investor has to pay 959. So it is outflow. So we take minus. And these are the inflows to the investors. 96. And the last one is 96 plus the redemption value is 1000, the face value. All right, fine, good. And then we found the IRR. So what we are getting is 11.29. Okay, what the definition of IRR, that is internal rate of return, is? It is a rate at which NPV becomes 0. Okay, and we tested this. Okay, we again put the NPV function, okay, at a rate of 11.29, and the future cash flows are discounted, and what we are getting is plus 959. So what the net effect is? 0. So other way of saying what the IRR is, we can say it is the reinvestment rate. It is the reinvestment rate, right? And later on, after some time, you will see that even the IRR is basically equivalent to CAGR also, that is compounding annual growth rate. Or in the bond parlance, what we say is the YTM, that is yield to maturity. I hope it is clear. Yeah, so very good. So I think Atul is saying, so we bought at a discount and hence the yield is more. Yeah, correct. So Atul got the point here. Yes. So 959. So the thing is, if you are doing with me, you can test instead of minus 959, you just put minus 1000. And then what the IRR will be equal to 9.6 only. You just test it. So let me, let's put minus 1000, and what the IRR will is 9.6. Okay. Now, one more data we will take, because this is also quite popular instrument. Okay. And on the search bar, we go with sovereign gold bonds. Is it fine? So we'll go with the sovereign gold bonds. I'll take the first one only. Okay. And again, we are working on the rate. Fine. Okay. So sovereign gold bond, let's click on this. Okay, so I will come to your point that how it is CAGR, how it is YTM. I will come to that point. Let me take one more instrument. Okay, so quite popular. You can see my screen. Okay, it's sovereign gold bonds, 2.5%, April 28, series 1, 2021. Okay. Okay. What we need is what the face value is, at what price the bond was issued. Okay, what we can see as of now is the current price. Okay, this is today's price on the exchange, which is 8,510, right? So here you can see the face value, and it is 4639. Okay, so this is 4639. I will come to the explanation of CAGR and YTM also. Just wait for some time. So it was the sovereign gold bond. I'll put the year 2020. And as of now, we are in 2025. Okay, what the face value given on the exchange side is 46 4639, and the rate of interest, which is the coupon, is 2.5%. So let's see how it works. So the first thing is, we put minus 4639. This is the price paid when the bond was issued in April 2020. This was the price paid. And then semi-annually, okay, the payouts are 6 monthly, but rate is quoted annually, so 2.5% on the face value. 2.5% on the face value, it goes to 115.97. So 115.97. And these are, as I said, the rate is quoted yearly, but mostly the government securities are half-yearly compounding. Okay. So what we mean by half-yearly compounding also I will explain. We call it intra-year compounding shortly. So these are the cash flows. Okay. Now next is if investor want to know what are the returns, what is the compounding annual growth rate, right? So how it can be found? So we have written the cash flows, and as of now, the price is 8509. So the coupon 115 and then 8509. Okay, so first please focus here. We have written the cash flows. And we want to know what the returns are. All right, so again, what we do is we go with the IRR, okay, and refer the cash flows. And refer the cash flows. And what we are getting, okay, let me enter this. So up to 2 decimal, it is 14.90%. Okay, this I'm saying till now, right? From the time of issue till now. So what we are getting is 4.90%. Okay, and what we have seen that IRR is a rate, at which the NPV becomes zero. It is also known as reinvestment, compounding annual growth rate, yield to maturity. Fine. Okay. But I will not say, as of, see, with this example, I will not say YTM, because YTM is if we buy, now and keep till maturity. So don't get confused, please. So as of now, I'm not touching the YTM part, but this is the CAGR. Now the question is how it is a CAGR. Correct. Now for calculating the CAGR, okay, we can use the rate function. Okay, we can use the rate function. This is a 5-year data. Yeah, it is 4.90 per annum. It is 4.90 per annum. Okay, and this is what we are testing, actually, how it is compounding annual growth rate. So we'll go with the rate function. Okay, and if you see the parameters, okay, what the syntax is saying, n per. Okay, so this is 5-year data, so we'll go with 5. Okay, so n per number of period is 5. PMT means what the periodical payment is, and the periodical payment is 115.97, 115.97. Okay, present value, right? What amount is paid? Okay, what amount is paid? and the amount paid is minus 4639. Is it fine? And what is the future value? So as of now, it is showing 8509. Okay, rest of the parameters we don't need, those are optional. And if you go with this CAGR, what we are getting is 14.90 only. Why 8509 is added? Okay, so the thing is 8590 is the current value. This is what the current value is. As of now, what the price? Okay, here it is. I have taken 8509, but actually it says 8510. So let me do 8510. Okay. See, these are the variable, focus more on the process, right? So 85 not 09, but let's take the current value, which is 8510. And here also, let me modify 8510. I hope it is clear. Okay, we'll go with the next part. Very, very important. Okay, what are the types and the conversion, right? So this is a bit technical. Okay, so the first point is nominal rate, which is basically yearly compounding. And then we have the effective rate, okay, which is a case of intra-year compounding. Okay. So two things, nominal rate and effective annual rate. Okay, let's first understand first two, and then we'll go with the rest of the things. So two scenarios, okay, let's see two scenarios. The one is, let's say, the person goes to, let's say, SBI bank and do the FD, which is giving, for instance, we know the currently the rate of interest is around 6.8%. Okay, but I'll take the round figure. Uh, let me go with, for instance, 10%. So what the data we are considering is SBI Bank FD 10% per annum. Okay, and this is basically nominal rate. And I'll take some other bank. Okay, for example, a hypothetical I'm taking XYZ, and there the FD is 10% per annum, and compounding is, for instance, semi-annual. Okay, so two banks, and for both the banks, okay, let's say the FD is done for, I'll say FD is done for, let's say, 3 years. And the thing is, we have to find maturity. Okay, so we are understanding, if it is a nominal rate, something compounding annually. If it is a case of uh, compounding half yearly, right, the frequency is more. So basically, this case, the XYZ is a case of, we call it basically intra-year compounding. So if it is a case of intra-year compounding, that is within a year, if the compounding happens, the maturity will be different. Okay, but the thing is, more important thing is how we can convert this intra-year compounding into the annual rate. Technically, we call it effective annual rate. Okay, so in short, we say EAR. So how it is possible? Okay, so first let's go with a simple case, SBI case. And simple, if it is, let's say I'll just will take 3 years, and somebody do a FD of 10,000. Okay, so what is the value in the third year? And it is simple, your 10,000 is growing at 10%. Fine. So next year it will be 10% more. So on 10,000, 10% goes to 1,000. Fine. And then again on the 11,000, 10%, it becomes 12,100. And in the third year, it becomes 13,310. Is it fine? So this is what we have done is with the SBI. Okay. But in case of XYZ, it will be very different. Okay, because compounding is half yearly. So what we are going to do somewhat different, right? Okay. So how it works? So please understand, when we say semi-annual, that is half yearly, we have 2 half in a year. Okay, so let's say 2 half can be like January to June and then July to December. Okay, and here let's go with a period. Let's say first period. What the deposit is 10,000. Okay, and again, if you see the rate is 10% per annum, right? But since it is half yearly compounding, okay, what we do in the second scenario, this 10%, okay, this I'll do here, this 10% we divide by 2. Okay, this is for the first half, that is 5% for the first half. Okay, so the rate is 10% by 2 because there are 2 half in a year, so 5%. And now what the amount in 6 months will be? Okay, so I'll put Jan to June. Okay, so what is the amount at the end of the 6 month? So sixth month. Okay, and pretty simple. So it is your 10 into 1 plus 0 0.5, 0.05. Okay, so 5% on 10,000, it goes to 10,500. Okay, this is for the first half. And then we have July to December. This is the second half. Okay, so again, the period is what? The second period, second half. Okay, so the period is second half. And then again, what the opening balance is? Okay, so the opening balance is 10,500, and the rate is the remaining, that is 10% by 2. And then what the amount becomes, right? So at the end of first year, or let me put a general word, that is the closing balance. And then again the opening into 1 plus 5%. Fine. So if you see, now you have to observe one thing. If it is a SBI bank, at the end of first year, it is 11,000. But when it comes to the second scenario, that is XYZ, where the compounding is happening half-yearly, okay, it is not 11,000, rather it is 25 rupees more. I hope you are getting the point, right? That means effectively, right? Effectively, how much the investor is getting. And that's why the word is effective yield or effective annual rate. Okay, so this is what the advertisement, right? I've shown on the slides. The initial advertisement says effective yield. That means it is a case of intra-year compounding. Why? Because maybe the payouts are monthly, right? So there were different options. The payouts can be monthly, the payouts can be yearly, the payouts can be cumulative, that is on maturity only. Is it fine? So I hope you are getting the difference. And then the third half, right? And the thing is, this closing is the opening, right? So what I'll do is, instead of deposit, again a generic word, let's say the opening balance rate is 5. Okay, formula is already set. Okay, then comes the fourth period. Okay, the opening is the previous period, right? And again the 5%, and again the closing is okay. And let's come to the last one, the fifth half. Okay, closing 5. Okay, and then the sixth half, right? So total 3 here, right? So 3 into 2 is 6. So we have the sixth half. Okay, so all the formulas are set. We have to just follow the process. Okay, and what we are getting is 13,400, whereas if it is an annual compounding, it is 13,310. So some 90 rupees more. That means effectively, what the annual rate is. And it's again, what we can do is, if it is an Excel spreadsheet, we can go with the inbuilt function. The name says effect. Okay, and if the nominal rate is 10%, okay, and compounding is happening half yearly, so you can see the syntax, what the argument says, what the abbreviation is, n per, that is number of period, y means in a year, n per y, right? And it is 2 times in a year, twice. And what our answer will be, of course, at 10% it is 13,310. But when it is a compounding half yearly, it is more, 13,400. That means the rate what we are going to get here will be more than 10%. So it says 10.25. Yes, so you are asking, can we convert nominal to effective? Yes, you can see here. I hope it is clear, right? So we can use the effect function and we can find. Otherwise, of course, those mathematical formulas are also there, which is basically your 1 plus 10% by the frequency raised to the frequency and minus 1. So it should be 10.25, right? We are getting the same. So what the formula be? It is your 1 plus rate upon, sorry, 1 plus rate upon frequency raised to frequency and minus 1. This is the mathematical formula. So I think the nominal and effective funda is clear. Nominal is compounding yearly, whereas effective is intra-year compounding, more compounding, and can we convert into? The answer is yes. Okay, so you have nominal, you have effective. Let's go quickly with the remaining. I will take another 10 minutes, fine. So holding period, CAGR, yield, and IRR. Okay, again, some real data only, let's take. What I've done is, I've taken some fact sheet, okay? So for instance, this is just for the educational purpose, nothing to promote here, uh, purely for understanding the concept. So you can see couple of websites I open. One is the SBI and second is the HDFC, okay? And from both the company portal, already downloaded the fact sheet, okay? You will find the fact sheet. This is your SBI and then we have the HDFC. Okay, so let me go first with We can take, see, I am always taking two data to verify, right? To be more clear on the concept part. So with the SBI, again, no choice. Whatever the first fund comes, I will take that. Okay, you have to focus on only few things. Nothing going to be on the mutual fund part. Purely on the rate, right? Purely on the mathematical part. Okay, so later on, please explain. Yeah, so please wait. We will see XIRR, what you are asking, and the CAGR. So with this data only, we will understand. Okay, so first thing, please understand what the data I'm taking is. So on the left panel here, you can see the date of allotment. You know, it is 14/2/2006. Okay, so the allotment happened. The inception date given is 14/2/2006. Today it is 13/2/2025. So we can say 19 years, right? 2006 to 2025 is 19 years. And again, the basic, we know that the face value, of the mutual fund portfolio is 10 rupees. Fine. And let me go what the price as on, this is 31st January data. Okay, this fact sheet is of 31st January, and on 31st January I'm taking one data point, one price, which is, you can see, 95.51. Okay, so in 2006 it was 10 rupees. 2025 it is 95, right? Okay, and the thing is, we have 19 years, right? 19 years. So I'll put the time period is 19. Now please understand, the first returns what we are going to understand is HPR, and then we will come to CAGR. Is it fine? Okay. Now when we say holding period return, as the name say, holding period, right? So it's pretty simple, 95 minus 10 and divide by 10. Okay, how much you are getting? 95 minus 10 upon 10. 8.5 times. Okay, this is 8.5 times. In percentage, it goes to 850%. So the holding period return is 850% or 8.5 times in 19 years. And let's say, the person do like this, 850 divided by 19. This is misleading actually. This is not correct, which comes to something 44.74. This is misleading actually. Okay. So holding period return 850 is correct, but dividing by 19 is wrong actually. And that's why what the regulator, let's say in Indian scenario, what the SEBI says that, and everywhere, worldwide, all the regulators, what they say is that it has to be presented in terms of the compounding growth only. Okay. And when we go with the formula, okay, so let me go first with the formula and then the Excel function. So this is the formula, is right? That means the future value, which is 95, it started with 10 in 19 years. Okay, and let's see what the answer we are getting is 12.57. Right, so 12.58 up to 2 decimal. So this is what the compounding annual growth rate is. Now, what is 12.58? Let's see here, right? So we started in 2006. It started in 2006, and we'll take data till 2025. So it started with 10 rupees, and then this 12.58 is every year, right? So we'll cross verify this. So 12.58. Okay. So 10 next year at 12.58 will be 11.25. And if we go like this, okay, our 2025 values should be 95. So we are getting 95. I hope the funda is clear. So what we did here, just see, initial value is 10 and then 12.58 every year. So I hope the CAGR funda is clear. So 12.58, then again on the previous balance, this is what the compounding is. So again on 11.25, again 12.58, correct? And so on till 2025, it becomes 95. Okay. Or now the thing is, you know, what I introduced initially was the IRR. Okay, let's test with the IRR also. Invested is 10. So I'll put, we go with minus 10 because outflow. This is how the IRR function works. The inbuilt function works. So minus 10. And we don't know in between what the values are. Okay. So putting 10 rupees in between, it can be any value. We don't know. And at the end, it becomes 95. Right. And let's again go with the IRR funda. Okay. And let's see, enter. Okay. Up to 2 decimal. What we are getting is 12.58. So, but the way it is presented is different. I hope you are getting you are getting this, right? The end value is same, but how the numbers are presented are very different. But end result is same, right? That's what I said in the beginning, that IRR is equal to CAGR in terms of the output only, not the way it is presented. So if it is a absolute numbers, like initially we have taken the absolute numbers, right? So these are the numbers, absolute numbers, right? These are the currency values. So if we have the absolute numbers, then IRR is a best way, right? To know the yield or to know the returns. So 12.58. But the thing is, CAGR can be computed in different ways. Actually, there are a couple of more ways. So the first thing is, I'll repeat. First, we found the HPR, which is 850%. Okay, and then uh, we found the CAGR. But the thing is, can we convert HPR into CAGR? And answer is yes. This is what the conversion is. So the holding period returns can be converted into CAGR. Answer is yes. Okay, so pretty simple again. So it is your 1 plus HPR and raised to, again, it is the nth root. So 1 upon n minus 1. Okay, XIR, just I think Archan Kumar. I will explain. I'll come to that part. Okay, so 1 plus HPR raised to 1 upon n. And the thing is, let's take the data 1 plus your HPR raised to, this data is of 19 years. So HPR have to see, if any prospector says HPR, then it should put in the footnotes that it is calculated as a HPR. Okay, don't divide by the number of years. That is misleading. Actually, this is what the regulator says. It cannot be presented as a average actually. Okay, CAGR always do the calculation on the actual previous period balance, right? So when we convert HPR into CAGR, 12.58. So our focus should be on HPR. Once we know HPR, then we have to consider the time period, whether it is a 1 week, 1 month, 1 year, or 10 years. The period plays very important role, right? If we know the period, then we can find the CAGR. And what is CAGR? On an average, what are the returns every year? And it always calculate on the previous balance. So 10 become 11.25. And then to find the 2008, what we have done is we have taken the previous balance only, which is 11.25. Okay, but just imagine with 44.74, it will not be 95, it will be something else only, very big number with 44.74 returns, right? It will be really drastic change. It will be not 95, but something in lakhs only it will go. Okay, I'll come to the yield and XIRR. Okay, so we have seen holding CAGR. Okay, couple of more, yield and XIRR. Okay, so again, we'll go with the real data only, what we have taken from the website. Okay, so this is the data, I think, yeah. This is the data we have taken from the NSE. 959 is the price of, I think it was India Info Line, and 9.6 is the coupon. Okay, so I'll put here, this is the coupon, and this is the par value. Okay, and this is the time left for maturity. Okay, so time to maturity is 3 years. Okay, now let's come to what the yield is. Okay. So as we say YTM, that is yield to maturity. If any debt instrument is bought today, okay, in our case it is 959, and if it is hold till maturity, then what are the returns? Technically we call it YTM, yield to maturity. Again, what the parameters we need? Okay, we need the parameters. What is the price paid today at present? So we need PV, right? So our 959, so please understand the terminology, okay, how it changes with the instrument. So in the fixed income securities, the price paid is the present value, which is 959. Okay, time to maturity is 3 years. Okay, on maturity, what the amount will be redeemed, it is a face value, which is 1000. Okay, and every year, what is the amount paid by the issuer? Okay, we call it the coupon amount, which is 9.6% on 1000, which goes to 96. And the thing is, again, we are using the same function, okay, which is a rate function, the one we used for the CAGR. Okay, and if we go with this, so 3 years, okay, PMT is the periodical payments or receivables, which is 96. What is paid today, present, is 959 minus, because it is outflow, and in future it is 1000 return, right? So it has to be 11.29. So up to 2 decimal. I hope the yield funda is clear. Any question on that, please let me know. Okay, yield is clear, right? Okay, good. Okay, and the last is we go with the XIRR. Although I have not written on my slide, but since you are asking, most welcome. What is XIRR? So IRR already we have done, right? Which is your CAGR in terms of the output. The methodology is very different, but in terms of output, it is same only. Now, you check here when we did IRR, and you observe here it is 25, 26, 27. That is, it is a uniform period. correct? The period is uniform, but practically it's not uniform. The coupons or the dividends or the cash flows can differ. It can be postponed by a quarter's time, or delayed by, let's say, 2 months, 4 months, 3 months, quite possible. Same way, dividends are not, see, we say periodical, but they are not uniform, that every year on 1st April, we will get the dividend. It's not like that, right? So practically the cash flow differ. And when it is uneven in nature, then instead of IRR, what we do is what the Microsoft people say is XIRR. Again, you will not find all these things in the books, but it is the MS uh, terminology. This is how they define. If it is an uneven cash flow, we go with XIRR. Okay, now since the cash flows are uneven, what we need is dates and the cash flow. We need two things. But when we use IRR, only reference is over the cash flows, the values. But uh, let's type XIRR and check the syntax. There are two parameters. One is the value and second is the date. Correct? So why date? Because period is uneven. It is not like every 31st March or every 31st December. Sometimes the cash can come on 1st April, the second cash can come on, let's say, 15th August, the third cash can come on 15th December. So if it is uneven, then how to consider those cash flows? That time we go with the XIRR. Okay, so with the screener, what you are saying, if you are sourcing data from the screener, now the thing is that have to be cross-checked. That's why, see, understanding, if we know the returns, how it is done, and if we know uh, the basic, interest rate calculation, then only we can see whether the screener have represented in terms of HPR or CAGR or average. So I cannot comment as of now without seeing their data actually. I hope it is clear. Can we go with the Q&A?
Uh, Sorry for interrupt, sir.
Yeah,
But
yeah.
because we are running out of
Yeah,
time.
yeah. So it is done from my side. I have explained, what I have to explain in 1 hour.
So we'll
So
take only two questions from
yeah,
Q&A section.
yeah, yeah, please, yes.
Sir, you can select any two question from the Q&A section.
Okay, so I can go with the calculation part only. So one is, okay, I can see a lot of Q&A. Okay, so Atul is asking, Atul, extended IRR, that is, I hope you are asking for XIRR, takes into account the repayment cash outflow also. Yes, all the cash flows. We have to write all the cash flows, dates and cash flow. So corresponding with the dates, we have to write the corresponding cash flows. So we have to. I think IRR, XIRR explain. I'll go with one more, which is by Matang. And what the question is, it is nearby 4,600 becomes 8,500. It's how just 14 CAG. Okay, I hope it is CAGR. So now please understand, Matang, your question is 4,600 become 8,500, not in 1 year. It's a 5-year data, including the coupons. So don't think it is 100%, close to 100% that 4,600 become 8,500. You know, so so the thing is, if you are thinking that it almost double, that is a holding period return. You have to consider the time period also, which is five years. So hence we will go with the CAGR. I hope it is clear now. I hope it is clear, right? With the Q&A.
So because of
Yeah,
time
yeah,
constraint, I
yeah,
think we
yeah,
should
yeah.
end the seminar here.
Yeah, fine, fine, fine. All right.
Thank you very much
Yeah.
for all for joining today's webinar. I would like to express my heartfelt gratitude to our esteemed speaker for sharing their expertise with us. Thank you so much, sir, for the insightful session, and a special thank to our audience for your participation and engagement. A quick reminder for all the participants. Certificates will be sent in 3 to 4 days, and the webinar recording will be available on NISM YouTube channel. So I officially close today's session. Stay connected with us for the future webinar. Thank you. Have a great evening.